Hey, what's going on, everyone? It's Griffin here, and I hope you're all having a great day as always. Now, recently, I've realized that my older content was a lot more focused on long-term investing, as well as how to really start investing as more of a beginner. However, with current market environments and everything that's going on in the stock market, I've sort of shifted a lot of my more recent content to stocks to buy, as well as some more trendy content related to stocks, business, and general investing. But if you are newer to investing, it's still really critical that you don't just jump headfirst into the market and buy a handful of growth stocks and speculative plays without having a well thought out strategy and plan in place for long-term success in the markets. Because at the end of the day, while it's easy to get really excited about the next growth stock that shows opportunity, if you don't have a well thought out longer term strategy for the growth of your portfolio, then you're exposing it to unnecessary risk, and that's absolutely not what we're about on this channel. So with that said, today's video is going to cover a 5-step process to get you started investing on the right track if you're new to stock market investing. It's a pretty long video, so sit back and relax, but at the end of it, you're going to be able to tackle the market with knowledge on how to properly construct a portfolio that suits your needs as an investor. I really hope it provides you some value. Let's get right into step number 1. Alright, so the first step to follow when you're just starting out is probably not what you would expect actually, and that it's not to go ahead and purchase a handful of growth stocks without any further thought process behind the decision. The first step is actually to take a step back and reflect on your life and financial situation, your goals as an investor, and the time horizon for which you're looking to stay invested, and then also the risk tolerance that you're able to manage for your portfolio in correlation with the previous points. I know this is probably not the most exciting first step here in starting to invest in the stock market, but it's really important because when you're first starting out, you're going to probably be looking at a lot of various information which tries to make blanket statements about investing as a whole in the stock market and other forms of investing. And while that's fine, most of this financial information does not apply to every single investor based on a variety of characteristics based on that investor's profile and what they're looking to accomplish with their investments. For example, a certain stock or fund may make total sense in your portfolio while it might not make sense in my portfolio. And the same holds true for the actual portfolio construction and asset allocation within the portfolio, in that it may be completely different for an individual who is, say, older and has less tolerance to risk than what my asset allocation would look like in my portfolio. As someone in their mid-20s, I'm personally looking at decades of investment horizon ahead of me, and for this reason, I'm more comfortable taking on a higher level of risk in my portfolio and riding through multiple market cycles, which is inevitable. So this really means a higher portfolio allocation to equity and equity funds over, say, fixed income funds, which tend to have less volatility. So yeah, I would really just take a moment here before you jump into actual investing to self-assess what your goals are as an investor, what you're looking to try and get out of your investments, and then also your time horizon and risk tolerance, which is going to all be really important for step number 2 in the process. Alright, so once you've taken the time to self-assess, the next step here is going to be to apply this information to your portfolio asset allocation split. And what this means is, of the capital that you have to start investing with, how are you going to deploy it into your different portfolio holdings relating to equity positions as well as fixed income positions. And this asset allocation split is going to differ depending on everything we spoke about in step number 1. Again, this is a really important step in proper portfolio construction that you don't want to skip if you want long-term growth of your portfolio, because if you get really excited and you go out and allocate, say, 85% of your liquid cash to Tesla or Netflix stock exclusively, well, your portfolio is going to be heavily overweighted in that 1 or 2 single position, and for that reason it's going to be very difficult to achieve consistent longer-term growth. By the way, in the next steps, we will be speaking further about the percentage split for stocks versus exchange traded funds, which I always recommend investors hold in their portfolio. But for now, we're just going to be speaking about the general overall asset allocation split in the entire portfolio. The most important factors coming into play here are investment horizon and risk tolerance. So the following 3 splits are just models to base yourself on, but then you can select one as sort of a starting point and then tailor it further to your liking. The first portfolio for individuals who do have a longer time horizon and higher tolerance for risk is called the aggressive portfolio split, where I would allocate anywhere from 85 to around 95% of the portfolio to equity, ETFs, as well as stocks. And then the the rest of the portfolio would be comprised of fixed income positions. This allows for higher volatility, but also time to ride through multiple market cycles and creates a higher return over time. The second portfolio split is for individuals who want slightly more stability, but also want their portfolio to be exposed to a higher percentage of equity positions for that longer term growth. This would split the portfolio at around 75% equities and around 25% fixed income. But again, none of this is set in stone, and you should tailor it to your needs and your own portfolio. And then finally, for investors who may have a shorter investment horizon and lower risk tolerance, I would go for a 50-50 split. And the reason being is that in today's market environment, if you want more stability and portfolio income, there are still lots of quality dividend stocks to choose from that can yield high dividends while being significantly less volatile than, say, tech stocks and even the overall market. I'm just of the mindset that at the present moment, a higher concentration in equities, regardless of investor goals, is more strategic. But again, I'll reiterate that these are simply model portfolios to base yourself off of. So that's it for step number 2, where you'll be picking an asset allocation split and then try to build a portfolio that's tailored around it. So once you've determined the type of investor you want to be with your goals and needs, and you've also determined the asset allocation split that you're going to move forward with for your new portfolio, it's now time to actually open up a brokerage account. Now, if you're a new subscriber to the channel, this may be the first time you hear about a stockbroker, but if you've been following the channel for a while, chances are you already have a stock market investment account open with a certain stock brokerage. Basically though, a brokerage account is pretty much a bank account, but that also allows you to buy and sell financial securities that trade on the open markets, like for example, stocks, bonds, exchange traded funds, mutual funds, commodities, and other financial vehicles. And the reason why you need one of these brokerage accounts is because you can't buy any of the previously mentioned financial securities in your traditional checking or savings account. But lucky for you, we aren't in 1990 anymore, and opening up a brokerage account literally takes less than 5 minutes. Now, if you're Canadian, I would recommend using either Wealthsimple Trade or Questrade, which are both discount stock brokerages that offer either completely free trades or very minimal trade fees on both buy and sell orders. I do have full comprehensive walkthrough videos of each one of these platforms if you are interested in learning more about each one. I'll leave links down in the description to those videos so that you can get more informed on which brokerage you're more interested in. If you're American though, you can pretty much open a brokerage account with any of the banks that you're currently dealing with, or I would also recommend Webull, which is another mobile online discount stock brokerage. Once you've chosen the brokerage that you're going to use to start investing with, now comes the time to actually open up an account. And once again, there is some variety to choose from here in terms of the account type that is going to be split between 2 main categories. We first have what's known as registered investment accounts, including the tax-free savings account and RRSP in Canada, along with the IRA, Roth IRA, and 401k in the United States. And we also have what's known as a non-registered account, which is basically just a cash account that has no particular quality to it that makes it favorable. By the way, you may see with certain brokerages that they have what's known as a margin account, and for the most part, this is exactly the same as a cash investment account, although you can also access margin in order to leverage up your funds and make larger trades. This, however, is not something I would ever recommend for new investors. Let me explain a little bit further though if this is the first time that you're hearing about any of these account types. So starting with the registered category here, these are investment accounts that are monitored and regulated by the federal government. And for this reason though, they do offer certain tax sheltering incentives. With that said though, if you are a new stock market investor, I would recommend that you first start using the TFSA in Canada or the Roth IRA in the United States, because generally speaking, this is going to be the most tax efficient and beneficial for long-term tax-free growth of your wealth. This is because as an investor, you can contribute an amount to these accounts each year that is going to grow on a tax-free basis, meaning that as the value of the investments grow, you never have to pay any taxes on them. Even when you sell them later on down the line, you're not going to materialize what's known as a capital gain, which you would have to pay taxes on if you were investing in a simple cash account. And what's best about the TFSA or Roth IRA is that if you're above 18 years old right now and you've never contributed to the account, well, the contribution room is actually cumulative, meaning you most likely have a sizable contribution room available to you that you can start investing with. So at this point though, we're in pretty good shape. You've self-reflected on your needs and goals as an investor, you've determined the asset allocation that you want for your portfolio, and you've most likely opened up a brokerage account and the perfect account type for you. And at this point, we're now going to be purchasing some exchange traded funds as the first step in building your solid portfolio for long-term growth. Now, here's the thing. For new investors, I always recommend that when you're first building out your portfolio, you purchase a variety of core exchange traded funds that are going to act as a line of defense, but also offense against the general market. This is a portfolio construction strategy that I've been speaking about and recommending to investors for years on the channel now, and still do myself to this day. I hold a handful of ETFs in my portfolio that I view as being core exchange traded funds that act as a solid base and foundation to the long-term growth of my portfolio. And yes, if you've been watching my channel for a while now, then I may sound like a broken record about this point, but I wouldn't be bringing it up so much if I didn't truly believe in it and have conviction about this strategy. And just quickly here, for those of you who may not be fully aware of what an ETF even is, it's essentially a basket of financial securities used to mimic a certain market index or facet of the stock market. So by holding one share, for example, of an S&P 500 index, you're gaining exposure to all 500 of the companies that make up that index. And there are thousands of ETFs to choose from for countless strategies and investment interests. But for new investors, you absolutely need to hold an ETF that tracks the S&P 500 index, the NASDAQ 100 index, a diversified bond index, and then also the ARK Innovation ETF. Possibly, these are all going to be core portfolio holdings. Again, I have multiple videos in my beginners playlist that go over all of these ETFs and how you can allocate them accordingly in your portfolio. But these core ETF holdings have to now fit within the confounds of the asset allocation split that you determined previously in this video. What I recommend is that the ETF portion of the portfolio makes up at least 50% of the entire portfolio, right? So if you're young and you're looking to have, say, a 90% equity and 10% fixed income split in the entire portfolio, well, 50% of that total should be ETFs, meaning around 45% in the equity ETFs and then around 5% in the fixed income ETFs. With that said, for fixed income positions and with the average investor, I usually recommend that the entirety of your fixed income position be comprised of fixed income exchange traded funds. Step number 4 here is really important for proper portfolio construction, in my view, for the average investor, because while you may be excited to go and buy and sell certain individual stocks that you're interested in for various different reasons, well, those core holdings are going to spread out across the entirety of the market and therefore return an average baseline return for you each year, and also highly lower the overall volatility of your account. For reference here, to show you that I'm not just saying random stuff, the QQQ ETF, which tracks the NASDAQ 100 index, has grown at an average annual rate of 20.37% over the past decade. That is some stellar growth to literally just place your money into this fund and basically forget about it, while you can choose to more actively buy and sell stocks if you want to. So yeah, the core ETFs in your portfolio will act as that foundational layer for long-term growth of the portfolio. And do yourself a favor when just starting out, take a long-term approach with your investing if possible, because this truly will be the most rewarding and beneficial for the growth of your portfolio as well as wealth over time. And skipping the ETF step, in my opinion, is a mistake that I want you to avoid. Alright, so moving on now to step number 5 in the process, we're going to be briefly speaking about how to evaluate a stock, what I look for and what you should be looking for a stock that shows long-term potential for growth in value and therefore benefiting your portfolio. By the way, let's quickly remember here that company stock is essentially equity in that company. So if, for example, someone were to hold 15% of all of a company's stock that's out in circulation, they would essentially own 15% of that company. It does get quite a bit more complicated than this, but that is the basics of how company stock works. At this point though, it's important to remember that not all company stock should be treated and looked at in an equal manner. For example, some companies are going to be focused on rapid growth and expansion of their operations, and for this reason, generally their stock will be seen as a growth stock. On the other hand, we may have a larger and more established company in their industry that has more consistent revenue, and for this reason, they're more focused on paying out shareholders what's known as a dividend, and this can be considered to be a dividend stock. So while there are multiple different ways that we can cut up and group stocks together, for the most part, as a new investor, just remember that there are growth stocks and there are also dividend stocks. Again, I will reiterate that there are multiple different categories of stocks that as investors we look at. However, these are really the most basic forms of stock categories. And depending on what you're looking for in your portfolio and your goals as an investor, you're going to want to tailor the holdings accordingly in your own account. Lucky for you though, I have dozens of videos already on the channel going over stock picks and stock analysis for both dividend stocks as well as growth stocks. So while we will be speaking about some baseline criteria to look out for in today's video, I would also encourage you to watch my other stock pick and analysis videos and really just see what I'm looking for as an investor in terms of the company's financials, but also the business highlights of that company and what I look for longer term growth. With that said, let's now speak about a stock's quote and go over the information that's held within a stock quote, because this is pretty much going to be the first set of financial data that you're presented with when first analyzing a stock. So this is Amazon's stock quote on Yahoo Finance, which you most likely recognize the layout and format from all of my other videos, but the quote is like a dashboard that gives you relevant surface information about the stock you're looking at. Now keep in mind that the stock quote on various platforms will look different, but most of all the same information will be present. Up top, we have the company's name and ticker symbol used to identify the company in the public markets, followed with the latest price and variance in the day. We also have the company's previous close, meaning the price it closed at the day prior, the price it opened at during the day, the bid and ask price, which will fluctuate every second as individuals are trading stock, because always keep in mind that the stock market is like an auction house, but for financial securities. Then we also have the 52-week range, which is quite self-explanatory, and then also the volume, which is the number of shares that traded hand during that trading day. Now moving on to the right column of the quote, we have the company's market capitalization at the top, which is essentially the company's market value by multiplying the share price by the amount of shares that are circulating in the market. In Amazon's case, the current market value at the time of filming this video is $1.673 trillion, which is a staggering figure. As a side note, you may sometimes hear in the news that, for example, Elon Musk's net worth shot up by billions of dollars in one single trading day. And this is typically due to the amount of shares that that individual will be holding in a publicly traded company, right? So we learned earlier that a company's market value is the amount of shares out in circulation multiplied by the market value for each share. So if one individual were to hold, say, 15% of all the shares out in circulation for a company, well, if the share value were to shoot up in one single day, that's going to have a large impact on that individual's net worth. Moving on though, we have the PE ratio, which is an acronym for price to earnings ratio, and the TTM in parentheses here is also an acronym for trailing 12 months, which you'll often see in the world of stocks and finance. The price to earnings ratio is a simple division of a company's current share price by their earnings for each of those shares. The calculation also holds for the entire market cap divided by the entire earnings of the company. What this price to earnings ratio tells us as investors though is the price that each share is trading for relative to a company's underlying net earnings. And the net earnings are what a company has left over after subtracting the cost of goods, operating costs, and other costs from the top line revenues. You can think of this as the current price an investor is willing to pay for each dollar that the company is generating in underlying net income. And the price to earnings ratio is used by investors to quickly compare itself to the historic price to earnings ratio of that same company, as well as the price to earnings ratio of other companies or industry peers. Now, the thing about the price to earnings ratio to assess a stock's value in the current market environment is that it does leave quite a few elements out in relation to an overall assessment of this company's value, and can vary greatly depending on the industry it operates in and also what an acceptable price to earnings ratio would be for that company. For example, historically, tech stocks tend to hold an acceptable PE ratio that's much higher, often in the 30, 40, or even 50 range, while a more traditional company like a utility company will command a much lower PE because their growth is generally a lot slower and they are expected to be materializing higher net earnings since they aren't reinvesting the large majority of their earnings back into growth and expansion of their company. This is by no means set in stone though, and in current market environments, value is very relative in that there are so many factors coming into play here, and a lot of future earnings and expectations are already priced into the stock, which further drives up the value of these stocks and therefore also the price to earnings. For example, if we look at the S&P 500's average PE over the past 90 years, we can see on this chart that while it does fluctuate, we're currently experiencing a market environment with quite high PE ratios. So it is quite difficult to use this metric accurately right now, other than for comparing it to industry peers. But nonetheless, that is what the price to earnings ratio is, and it's really important to understand how it works as an investor. So hopefully this allowed you to better understand this very useful ratio. If you have any questions, make sure to let me know down in the comments. Moving on down the stock quote though, we have the EPS or earnings per share. And as mentioned, this is the earnings the company is producing per share of the company out in circulation. And finally in the stock quote, forward dividend and yield. So if a company does end up paying out a dividend, the information relating to this would appear right here with the actual dividend in dollars and then the yield relative to the market share price as a percentage right here. Amazon doesn't pay out a dividend though, so no information is displayed. Beyond the stock quote though, any company that you're looking to invest in should be accompanied with a further analysis of the company's financial statements, including the income statement as well as the balance sheet and also relevant supporting business information. Now, I could honestly go on for hours about each one of these financial statements as well as other information that I look for in stocks, and that's actually exactly what I have done in my full stock market investing course, and I'd highly suggest that you consider taking a look at that if you're serious about understanding how to navigate a company's financials for better understanding of what's going on behind the scenes, which is critical for a company's long-term success and therefore your investment. But we'll still quickly run through some high-level information to look out for in these financial statements, starting with the income statement. Alright, so the income statement is a financial document that provides information about a company's revenue and net income with basically everything in between. At the top of the income statement, we have the total revenues, also referred to as the top line. And this is quite simply how much money the company generated for the reported period. Obviously, I like to see continued growth for the revenues each calendar year, because if a business isn't consistently growing and generating higher revenues, they are contracting, and that's not what we want as investors for increased share value over time. Now, keep in mind that depending on the industry and size of the company, acceptable revenue growth will also vary, right? So with a growth stock, we're probably going to see year-over-year growth of 10, 20, even 30%. And as an investor yourself, you need to use your critical analysis to ask yourself, well, is this growth acceptable for the company in question that I'm analyzing? You'll also want to take a look at the gross profit and operating income on each of these lines. As a general rule, increases in each is favorable over time, and so is a growing relative percentage. If a company is highly increasing revenues each year, but then their costs and operating expenses are also increasing to the point where year over year their operating margin is shrinking, this is not something that I like to see as a long-term investor. And finally, for the income statement, we'll take a look at net income, which we spoke about previously in the PE ratio, since this is the value used in that equation. The net income is what's left over from the revenues once costs of revenues, operating expenses, and all other expenses are taken into consideration. And the net income is also what we refer to as profit. Now, at the end of the day, a company needs to be profitable at some point in time because they wouldn't be able to sustain their business operations if their expenses are always exceeding the income that's coming in. If this was the case, they would have to continuously raise capital through new share issuance and therefore dilute shareholders, or issue out bonds, or raise capital other ways. So while you'll see that a lot of tech companies are not profitable, that is normal for some as they aggressively expand and reinvest all of their capital, like for example Shopify that we're looking at right now. You do want to see a company striving though for profitability at some point for a long-term investment. Again, the amount of relative profitability that's acceptable for a given company is going to depend entirely on that company in question. So it's really difficult for me to make a blanket statement here, but as a general rule of thumb, try to look for companies that are increasingly profitable year over year. Back to Amazon quickly, we can see that while Amazon isn't the most profitable, they are increasing this figure year over year. And anyways, Amazon is a growth play that's taking over the world, so looking at revenue increases is much more relevant than their net income. Let's now head on over to the balance sheet, which is the second most important financial document to analyze when you're looking to invest in a company. And the balance sheet is going to give us information about a company's assets as well as their liabilities. A company's assets are things that it has in its possession that either have value, increase in value, or generate them income. For example, this can include cash, marketable securities, property, equipment, vehicles, and the list goes on. But both assets and liabilities are also further split into two categories, being long-term assets and liabilities as well as short-term, or also known as current liabilities or current assets. And the difference here is that current assets and liabilities are going to come with a due date in less than 12 months or can be utilized very quickly in less than a 12-month period. For example, Amazon has $42 billion in cash and their total current assets are $132.733 billion, which I don't think I need to say is a lot of current assets. In parallel to this, they have $126 billion in total current liabilities, meaning debt and payables that are due within 12 months. Now from here, we can divide the current assets by the current liabilities in order to give us the current ratio. And I like to strive for a current ratio generally above 1 at all times, but even more favorable is a current ratio above 2. This just means the company has ample liquidity to cover their short-term debts. And then naturally, we have total assets and total liabilities, which group together the short and long-term figures. Again, I like to see a total ratio above 1, and I also like to see increasing total assets each year, which in this case, Amazon is doing. So that pretty much covers the very basics of financial information and data that I look for in companies that I'm potentially interested in investing in. And it's now up to you to utilize this knowledge and apply it to analysis of stocks you're looking to invest in, and then also apply them and mold it to your asset allocation in your portfolio. And that's a wrap on a quick startup guide for how to start investing in the stock market as a beginner in 2021. If you're interested in taking your knowledge one step further, then I'd highly recommend you check out my full stock market investing course, which has 6 modules and over 60 video lectures with hours upon hours of relevant content related to stock market investing, where you're going to learn absolutely everything you need to know about stocks, ETFs, real estate investment trusts, how to analyze companies, how dividends work, and the list goes on. If you're interested in that, then make sure to check out the first link down in the description, and don't hesitate to ask me any questions that you might have about the course down in the comments. With that said, make sure to subscribe and hit the bell button to be notified of new and upcoming investing content. And if this video was helpful to you, please take 2 seconds to drop a like. It really helps my channel out. So on that note, thanks a lot for watching today's video, and I'll see you in the next one.